everybody. Welcome to our third of a series of 4. We are talking about financing capital projects with new market tax credits today. We've gotten through 2 other sessions, and we have one more session coming up on July 26th. We will be covering organizations and their next steps in community development. And we will be having a link to that you guys can click on and learn more. Today, we will be focusing on, financing capital projects with new market tax credits. What makes a really good new market tax credit project? How can you tell, and how can you improve your project if you want to do that? My name is Laurel Tinsley. I am the Managing Director of Strategic Financing Services, and we are really excited to have 3 of our team members on today to talk to you through this presentation. A couple of housekeeping items before I make the introduction to our team members that are going to be leading you through the session today. If you want to receive CPE credit, you have to answer at least 3 polls. We have more than 3 polls, but make sure that you are on for the full time and that you answer at least 3 polling questions. So we do have 1 polling question fairly top of the hour. So we'll make sure we get everybody on before we start to that part. But again, CPE certificates should be issued in about 10 days. Don't worry if you don't get it right away, but CV Learning will be sending you an email with that. In addition, if any of your industry participants or anybody you know wants to know more about this topic, but they weren't able to join us today, a recorded version of this webinar will be available and it'll be posted on the website. If you have any questions, please feel free to pop those in the chat as we're going on today. So now it's time to introduce you to our team. Today, leading you through the presentation will be Janae Fenter, Joe Hennessy, and Trevor Nelson, and not in that order. Janae will kick us off when she starts. She recently joined our team in March of this year and is coming to us from another background working at a CDE. Joe Hennessy is also in our team, and he came to us. All of our team members have great background with other CDEs and organizations where they can sort of share that insight with you as they go. Joe Hennessy will be also presenting today. He is a manager in our Strategic Financing Services team. And Trevor Nelson is also going to be speaking with us today, and he has some great background with other CDEs and has been busy working on a couple of closings lately, as all the rest of the team have been too. Again, Q&A in the window if you want to do that. And let me just go through with you a few things that we're going to cover, and then I'll turn it over to Janae. So this is just sort of our baseline of who we are as an organization and sort of what our impacts have been. I think it's helpful for you to see that so that you get a sense of what community development and financing really means in numbers and cents. So raising money, we've been raising money for a variety of different projects since the inception of the New Market Tax Credit Program. We have investments we've assisted with from Alaska to Florida, almost 100. I think probably our numbers, going to be in triple digits soon. And, it's really about job creation. It's about people receiving new services, and it's about a lot of other things that our team members are going to be covering for you on the presentation. But this is just a snapshot of sort of how we have been impacting this industry. We will be covering today a variety of topics, as you'll see in a moment. I think we will be starting off with Janae, starting to talk about just the New Market Tax Credit Program and a background so that you get a sense of, what is this NMTC business you've heard much about? What's a QALICB and what's a CDE and what do those really mean? So QALICB is a qualified active low-income community business. And once you've been through this presentation, you will be able to, click that off. That's going to be the next piece of the puzzle is after we've talked about the new market tax credit background, what is a QALICB and how do you get ready to be a QALICB? One of the things that we often say is QALICBs are really just borrowers. They're getting a different type of financing. So QALICBs are the borrowers and they're the projects. They're the ones producing all these wonderful impacts we talked about previously. Financing preparation. So basically, since I said, this is a loan, how do you get ready to take on a loan? How do you get ready for a new market tax credit loan in particular? And what other sources of funding do you need to bring to the table in order to get new market tax credits? And then once you've got that mastered, that's when people start to take a deep breath in and deep breath out, and you get ready for your closing process. And Joe will lead us through that part of the presentation at the end. And we will kick it off now to Janae, who will start you off with what is the new market tax credit program, and how do you know whether you're sort of in the right space? So Janae, you want to take it away?
Thank you, Laura. So my name is Janae Fenter, and I'm a project finance consultant here on the strategic team in the Philadelphia area. And to get started, we will begin with our first polling question, just to get an idea of the new market tax credit experience of today's audience. So how familiar are you with the new market tax credit program? Never heard of it but never participated, heard of it and understand the concept, or worked on projects that receive new market tax credit funding?
While we give today's participants time to answer that polling question, it's a good opportunity to say that for anyone who enters questions in on the Q&A, we'll use this polling time to kind of field some of those questions as we progress through today's presentation.
Okay, so the polls are in, and it seems that some of you have some experience with new markets, while others of you do not. So let's begin with a bit of a history of the new market tax credit program. So during the Clinton administration, the community development industry had been working on ways to attract capital to low-income communities, also referred to as LICs, which eventually was enacted as a part of the Community Renewal Tax Relief Act of 2000. The New Market Tax Credit Program, Tax Code Section 45D, is managed by the IRS in a division of the U.S. Treasury Department called the Community Development Financial Institution, also referred to as the CDFI Fund. The federal government created the tax credit, which was a dollar-for-dollar tax offset to federal tax liability when invested in the low-income communities. This program began developing commercial investments in low-income communities in 2006. And since the formation of the New Market Tax Credit Program, the CDFI Fund has completed 18 allocation rounds, totaling $71 billion in tax allocation. The New Market Tax Credit Extension Act of 2019 provided a 5-year, $5 billion extension through 2025 with a 39% credit. So let's talk about next how the New Market Tax Credit Program works. Mission-driven organizations called Community Development Entities, acronym CDE, would apply to the CDFI Fund for New Market Tax Credit allocation. To become certified as a CDE, the organization must apply with the federal government and qualify with the primary focus of serving low-income communities. The application provides a very detailed narrative of what the CDE will utilize the tax credits for, with the track record as support to show what the CDE has done. This is a very competitive process where the applications are reviewed and scored. The most recent round awarded $5 billion in the fall of 2022 to 107 out of 199 CDEs. And if we look at the following slides, it will provide a flow chart displaying the participation in a new market tax credit transaction. A CDE applies to the new market tax credit allocation round by sending their application to the CDFI Fund, and the CDFI Fund then scores applications and awards winning CDEs the new market tax credits. The CDE then identifies and sells the tax credits to an investor, and the investor then makes a qualified equity investment, also referred to as the QEI, into the investment fund in return for the new market tax credits over the following 7 years. The leverage lender provides a loan into the investment fund, which is owned by the investor, who then provides a loan to the CDE. CDE then makes loans called Qualified Low-Income Community Investments, QALICBs for short, to a borrower who is in need of filling a capital gap of 15 to 20% to complete the development of an impactful project in a low-income community. Though NMTC structures and flow of funds come in many variations, this sample is a traditional leverage model. And now we can move on to the benefits of new market tax credits. So new market tax credits provides benefits to all participants throughout the transaction. The investor receives the tax benefits in forms of credits to be claimed on their tax returns, which is 39% of the QEI, and receives these credits over 7 years, 5% in the first 3 years, followed by 6% in the last 4 years. The CDE fulfills its commitment to service and improve low-income communities while providing flexible and affordable financing to support businesses in need of filling the gap, The sponsor builds a project at 80 to 85% of the actual cost and is also providing community benefits to that low-income community, such as job creation, access to community facilities, and commercial goods and services. Some examples of the projects these low-income communities benefit from include early child care centers, youth program and education, workforce development, health services, and healthy foods. So we discussed the program overview. Now let's take a look at the project impact. New market tax credit proceeds can bring 15 to 20% of net benefits to a project. For example, it could bring $1.7 to $2 million to a $10 million project of capital that can be paired or leveraged with the other sources for funding, such as owner equity, borrowed funds, or grant funds and capital campaigns, which make up 80 to 85%. A project cost minimum deal size is typically $5 million. With the combination of financing, the project benefits include features in flexible terms, such as subordination to other lenders at a low interest rate, interest-only terms for 7 years, and at the end of the 7-year compliance period, usually the ability to purchase your own debt at nominal cost. The new market tax credit is a gap financing tool to fulfill the capital needs to invest in low-income communities. And next, we'll see some of the investor motivators. A financial institution with motivators that are driven by reducing large federal tax credit liabilities and also fulfilling Community Reinvestment Act requirements to invest in distressed low-income communities. The purchase price is influenced by many factors, which include market interest rate, appetite, and need. This example shows 39% over the 7-year compliance period on a $10 million project. As illustrated here, an investor paying 81 cents per dollar of credit would achieve a 7.24% internal rate of return. And next, we will move on to a structure throughout the new market flow of funds. So the CDE will receive $10 million of allocation from the Treasury. The investor expects to have $3.9 million of tax liability over the next 7 years. And for each dollar of credit, that investor is willing to pay 81 cents to the investment fund. The investor would then capitalize the investment fund for $3.1 million. And this investment fund is an entity designed to combine the tax credit equity with other sources. To make a $10 million qualified equity investment, $6.8 million will be borrowed from the leverage source, which includes various sources of funding, such as private or bank loans, equity, grant proceeds, or fundraising dollars. Now that this investment fund entity has $10 million, it is able to make a qualified equity investment into a sub-CDE that is a subsidiary of the parent CDE. This QEI is a mechanism that initiates the flow of the tax credits for our investors. Once that investment is made, a clock is started by which the sub-CDE has 12 months to make its qualified low-income community investments, or QALICBs for short, into a QALICB. In most cases, this happens the same day as a QEI. The CDE typically makes 2 loans to the project. The A loan equates to the amount of the leverage loan, and the B loan typically is the amount of the equity investment and carrying a nominal interest rate, often at or below 1%. There are costs of closing with this transaction, and these costs are largely related to the legal expenses of documenting these entities, annual compliance and audit costs associated with the CDEs, and continued compliance with program requirements. This cost varies by transaction size and entity structures. And although a project of this size could see as low as 800,000 to 1.2 million in fees, for the ease of our example, we will use an average of those costs and expenses of $1 million. At the end of the 7 years, often what happens is that the entity, of the affiliate, therefore, will have the ability to acquire all or a portion of that investor's equity for a minimal amount. Next, we'll take a look at the overview of the math. So in this example, it shows $10 million of new market tax credit allocation with the federal new market tax credit rate at 39%, meaning $3.9 million of federal tax credits are generated. These tax credits are received upfront, however, they are received over time. 3.9 million in tax credits times 81%, 81 cents provides 3.1 million of equity investments from the investor and is the benefit to the project. The following line shows the estimated closing costs and fees, which as mentioned before, includes legal, audit, and compliance expenses. The $2.1 million is the estimated net new markets tax credit cash to the project. And now I will pass it over to Trevor to discuss QALICB preparation.
Thanks, Janae. And now you guys have a good understanding of what the New Markets program is. Maybe for some of you, that was a refresher. For others of you, this is completely new and probably still trying to figure it all out. But one of the things you probably took away from what Janae spoke about is the program's competitive. And we really want to spend this section on talking about how a project sponsor like yourself, or QALICB also referenced as, can find success in this process. So the first thing to keep in mind about this unique tax credit is that it's not an as of right credit. There's no governing body that says, hey, I followed all these rules, can I have my tax credit? Rather, it's a competitive program, as Janae mentioned, where it's truly public-private and CDEs across the nation go through a competitive process. And again, just as a refresher, the market opportunity on any given year right now is give or take 100 CDEs across the nation with their own unique strategies deploying $5 billion of credits. Now, what that means for QALICBs or project sponsors like yourself is, let's take the Carolinas, for example. If you're doing an industrial project, creating lots of good quality jobs in South Carolina, there's probably other similar projects. And so in order to find success, what needs to happen is you have to understand the nuance, as I like to say, the art and science of what gets these various CDEs excited. And ultimately, when it comes down to it, both CDEs and investors have very particular things they're looking at. So as we go through this, we hope you get a deep understanding and appreciation of how you can set yourself up for success in this competitive program. So let's dive deeper into a QALICB. We've been talking a lot about what a QALICB is. And so as we continue, what we'll find is that a QALICB is defined as a qualified active low-income community business. And there's a variety of different entity types that a QALICB can be structured as, such as a nonprofit, a partnership, et cetera. And while the New Markets program is incredibly flexible, and you won't hear me mention statutory requirements very often, I want to take a second to talk about what the statutory requirements are to be a QALICB. So first and foremost, at least 50% of the total gross income of the entity needs to be derived from the active conduct of a qualified business within a low-income community. And this idea of activity in a low-income community is something you'll see time and time again, because that's the ethos of the program. So continue on. What we also see is a substantial portion, as defined as at least 40% of the uses of tangible property, whether it's leased or owned, needs to be within a low-income community. And then finally, a substantial portion, again, as defined as 40% of the services performed for such entity by its employees needs to be in the low-income community. If there's no employees, note that the 40% from above turns to 85%. And if you have questions there, that's okay. We can follow back up. Another thing to keep in mind is that less than 5% of the assets can be in what we call non-qualified financial property, things like collectibles and cash. And generally speaking, from a structuring perspective, when you work with folks like ourselves, you can figure out how to make sure that NQFP isn't actually a problem. Finally, some projects are just outright prohibitive. In the new markets land, we refer to those as sin businesses, and think about things like golf courses, clubs, etc., where it'd be hard to justify the actual positive benefits to the low-income community. So now that we have an understanding of what a QALICB actually is, we want to dive into what makes a project attractive, at least at a high level. And to start, another statutory piece is location. I've talked about location quite a bit, and we'll come back to this idea that a project has to be in an eligible census tract. Next, we go to the community impacts. And what we like to say is not only does there need to be some community impacts, there needs to be demonstrated significant and quantifiable impacts. For example, there's a whole host of YMCAs, and each YMCA is doing incredible work. But for a new markets transaction, where we found success historically is when a YMCA is partnering with something like a local school system or a Habitat for Humanity who's doing for sale affordable housing to augment and amplify those impacts in an extremely uniquely way because the program is so competitive. While the but-for test isn't necessarily a statutory right, because the program is so competitive, various stakeholders prioritize projects that wouldn't get done unless the new markets tax credit equity were to fund the project. And so we really want to understand how is the subsidy going towards a project that otherwise wouldn't get done. And we call that the but-for test. And then finally, there's timing. There's a lot of contemplations that go into this process from the CDE perspective, like when to submit the next application, threshold dates, etc. But from the project sponsor side, there's a whole host of things that are within our control, such as having the needed board approvals in place, and things like understanding where the remaining leverage source is coming from. For example, for our nonprofit friends who may have never had to use a capital campaign bridge loan, or for some of our for-profit friends who have liked to use operating cash flows, having an idea of how this project comes together will be paramount in finding success, because CDEs and all stakeholders like to know that the timing and expectations are reasonable. And the way we control this is by having a lot of those items ironed out well in advance of a new markets closing and marketing the project to various stakeholders. Now, I've talked about location a lot, so let's dive deeper into what is a qualifying location. So currently, we're using 2015 census tract data. At some point in the not so distant future, we think this data will be refreshed with more recent data, but for now and until we get guidance, we're using 2015 data. And regardless of the year, right now, an eligible tract has to have a poverty rate of greater than 20% or a median family income of less than 80%. But one of the common themes has been talking about how competitive this program is. So while you can be in a qualifying tract, we encourage project sponsors to focus on trying to fit the higher distress criteria. The primary way to get there is to be in a census tract that has a poverty rate of greater than 30%, a median family income of less than 60%, an unemployment rate 1.5 times the national average, or be in a non-metropolitan county, which we'll talk a little bit about more next. Now, if you're not in some of those areas, what we'll find, and that's fine, we advanced the slide early, but what you'll not find if you're not in some of those areas, there are other ways to qualify. We call those secondary characteristics. And what we look at there is things like providing healthy foods in a census tract that is designated as a food desert, or providing healthcare in a medically underserved area, as well as a host of other things, including being in an SBA hub zone, working in a brownfield site, and so forth. And so keep in mind that just because you didn't meet the primary criteria, there might be a whole host of ways to qualify on the secondary criteria. And the vast majority of projects are in highly distressed census tracts, not just tracts that qualify. I'll also call out here that in another conversation, if you don't fit into one of the census tracts, there's another way to qualify called targeted populations. That's a conversation for another day. And again, not what happens most frequently. So as we go deeper into what these targeted geographies look like, First, I want to spend a moment on the non-metropolitan counties. And that's for two reasons. Number one, non-metro, we also refer to as rural counties, but it's not a one-to-one match like some other programs like the USDA. How the New Markets program defines non-metropolitan is census tracts located in counties not contained in an MSA. The other thing I want to call out about non-metro areas is that this is the one area where there's a set aside. There's a 20% set aside currently, which means $5 billion of allocation is currently going out the door. At least $1 billion of that is going to these counties. There's also something else we haven't talked about yet, but I want to introduce this idea of an innovative use. Community development entities write these competitive applications, and as a part of that, some of them check various innovative use boxes. One of these is underserved states, financing projects in states that haven't got as much new markets per capita as others. You can see the list of states here, and we also include the territories which aren't listed. And so you can start to get an idea of what a really competitive and attractive project could be for a CDE, where there's a healthcare facility creating outsized impacts in an underserved state like North Carolina and in a non-metro census tract. Now, we know those are few and far between, but as we start to think about how you maximize the attractiveness of a project, that's one way to think about it. So as we continue, what we find is, well, we'll take a moment for our next polling question. So we went through the location. We spent a lot of time on location. So we just want to know, is your project located in a qualifying location?
And while we allow participants to make their selection, I want to take pause and address a little bit more nuance to a question that was offered up of, can a city or a county be a recipient of the New Market Tax Credit Program? And what we saw in one of the earlier slides is that the real point that we would have to work around is that the borrower needs to be a corporation or a partnership. And so to the extent there's a way to create a public-private partnership or to re-engineer kind of who is receiving the New Market Tax Credit proceeds, there are ways to meet the needs of the city and county, but also to respect the requirements of the program. And if you would like to discuss that particular nuance further, please reach out to any of the presenters on today's call. We'd be happy to set up time to discuss.
Thanks, I appreciate that, Joe. We have a couple of groups, both on the CDE front and as project sponsors, who have figured out how to make that public-private partnership work. So if that is of interest, definitely reach out. And so it looks like some people don't know if their project is eligible, and that's okay. We have a couple of tools that can be helpful. Some folks are in eligible census tracts. So we're all over the board, and that's great news because obviously these communities need this investment, and we're excited that folks are across the board. So going on, we've talked a lot about, at this point, some of the requirements, what a QALICB, how to get into the right location. Now we talk about really the crux of what's a competitive project. What are these CDEs and investors looking for when they're going to market? There are things like, are you bringing accessible jobs that pay a living wage? And accessible being things like access to employment for those that might have barriers. Think about not requiring a 4-year degree or access to re-entrance. Are you bringing community goods and services? Think about a food bank in a food desert, or commercial goods like a grocery store, again, in a food desert. And this is all in places that have traditionally lacked those opportunities. Now, I talked about it at a high level, and while there's no necessarily perfect box, the next slide gives numbers to the impacts we typically see. And each community development entity has a methodology as to how they define impacts. Some CDEs talk about creating quality job creation, while some CDEs ignore that question altogether and focus on community services. So this is a generalization, and it doesn't mean if you don't fit this category that your project won't be attractive. It's just a high-level understanding. So on the job creation front, for those industrial and manufacturing projects, or even a lot of times with real estate and construction, CDEs and investors like to see 100 jobs per $10 million of allocation. On the community services front, the conversation is much more nuanced, but at a very, very high level. If you have a community facility where people are walking in, groups have said they like to see 5,000 people served per 10 million. And I want to call out that when I say people, I'm really referencing to those people in the low income community. Now, again, there's a lot of nuance here, because if you're creating a charter school and you're creating new classroom seats, or you're creating a hospital and have new beds, each CDE will have a different methodology and criteria, but we wanted to give a high level overview for framing and reference. Again, it also depends on location. If you're in a non-metro county where there's only 1,000 people and you're creating 60 jobs, that is very meaningful and might actually be attractive, although not necessarily in line with the methodology that I've described at a high level above. Another thing to keep in mind is project sizes generally need to be in excess of $5 million. But if you have a smaller project, there are some innovative uses for smaller projects. And then the other thing to keep in mind is the New Markets program is incredibly flexible. However, to go back to, again, the innovative use, there's an innovative use for non-real estate transactions. Think about working capital, equipment and machinery, et cetera. And so the uses can be very diverse, but we also find that CDEs like to focus on some of those innovative uses, especially working capital and machinery. So as you now have some understanding of what the numbers are, we really wanted to spend some time talking about what kind of projects actually get funded. And so as you see on the chart here, in 2021 and 2020, we see the most attractive project type was manufacturing, those quality job creators. There's quite a few CDEs that have found success really focusing on quality job creation. But not to worry, there's a whole host of other industries and asset types that are attractive, like healthcare, nonprofit hubs, and mixed use projects, and a whole lot of new asset types like for sale housing. There's some hospitality, museums. And so again, the New Markets program is very broad. And while manufacturing right now over the last couple of years has been attractive, $5 billion of credits is available. And so if you're working on something that's a little bit more bespoke, New Markets still might be a good fit. And so what are our key takeaways from all of this? Well, to start, the most popular projects fall within healthcare. And again, that's because you can have some quality job creation in the healthcare space, along with outsized community services, but also things like retail, again, for that same reason, and then quality job creation with industrial and manufacturing projects. But keep in mind that the most common project types that find success combine a variety of impacts, like I just mentioned with healthcare or retail. And again, just to be clear, so we're all operating under the same definition, we really think about mixed use from the New Markets perspective as the mix of impacts, not necessarily your traditional mixed use real estate concept, where we're talking more about the asset type or the tenant that's there. And so to wrap this section all up, what we really see is impacts and ideas on tenants come from community facilities like YMCAs or YWCAs, healthy foods like food banks, or we found a lot of traction recently with food halls. Healthcare, and we didn't talk about this much, but most commonly we see healthcare come in the form of FQHCs or federally qualified health centers, but other clinics and large hospitals have found success as well. And then quality job creators, as I mentioned several times before. So in conclusion, for developers in low-income communities or project sponsors, funding has flowed to projects that have a combination of impacts. Therefore, if your project combines those different aspects and you're in some of those targeted geographies we mentioned before, you have the projects that are most attractive. But again, $5 billion hits the street every year, as I like to say. And so if you don't fit this box perfectly, there's still ways to tell very compelling stories. And we see really cool projects get done all the time. So your project's attractive. What do you need to get it closed? Well, Joe's going to talk a little bit more about this, but just to give you a preview of what's to come, we got to figure out what the transaction is. Is it a startup or is it an operating company? Is site control underway? If we're leasing it to tenants, have those tenants been identified or in leases in place? And all of this helps attract a CDE because we can come to all the stakeholders and say, this transaction is a go and we're ready to go. So now I think you know what a New Markets project is and how to make it attractive. But just to summarize, we want to see significant impacts, a complete capital stack, and all the other broader real estate diligence items, being in a non-metro tract makes you eligible for that 20% carve out. And then having other innovative uses like being in an underserved state or using those QALICBs, as Janae mentioned, for equipment can make things really attractive. And with that, I'll pass it over to Joe.
Thank you, Trevor. So today's third polling question is, have you had conversations on where you would source your additional capital? Option A, yes, I have already secured it. B, yes, but not executed. C, no. Or finally, what do you mean source additional capital? And while you're making your selections, I wanted to ask Trevor one question that has come up from the Q&A world is, if my deal needs some additional attractive traits, are there any other attributes of the ownership group that could make my project more compelling?
Yeah, and I'm happy to take that, Joe. One of the things we found be really salient in the market today is diverse ownership. One of the trends that has been particularly topical is around how do you really use these commercial large-scale projects to drive wealth for communities? And so minority-led sponsors have found a lot of success. And that's racial minority is the definition that the CDFI fund is currently operating on. But that's something we've seen be really attractive. Another element there is Native groups as well. And so where we really have found some success, and while we didn't talk about it very much, there's been a lot of emphasis and focus on groups who are reflective of the communities they're in. So if that's a fit, there's definitely some attraction, even if some of the other pieces might not be all the way there.
Great. Thank you, Trevor. Okay. So the answers have come in, and it seems like some people have talked to their existing source financing partners, and others are just at the beginning stages and are really just learning what it takes to get here. So now that we've heard about some of the key aspects that can make a project more desirable for a CDE and investor interest, we need to be mindful that new markets aren't the only financing sources we need to account for. And this is often the most critical aspect of readiness that we need to be prepared for to attract the most CDE and investor attention. As discussed in the previous slides, new markets is just one and typically the last piece of financing that is brought to a transaction. This is the missing piece. And but for the new markets, the deal may not get done or would have to be reduced in scope or scale of services to be offered to the low-income community. So we need to be able to clearly identify sources that can work with new market tax credits and are fully committed to the transaction. So we'll go back to one of our handy diagrams here. And this should seem familiar, but what we're going to focus in on the left-hand side are the two most common points of entry for outside capital: the leverage loan and direct funding. Remember that in a new markets transaction, about 70% of the capital that runs through the larger new market structure must come from outside sources. And each of these sources will have unique considerations that we need to cover in the following slides. And at a very high level, these sources can be cash, whether that's from the sponsor's equity or through grants that have been provided by friendly groups, or debt. And that debt can be either lent directly into the structure at the investment fund, or it is now more commonly lent to an affiliate of the QALICB that will then use those proceeds to re-lend and extend their own loan directly to the investment fund. At the bottom of the chart, similar considerations exist, again, where the source comes from equity or grants, or debt from any sort of traditional or non-traditional lender. And all of these sources and where they make their appearance in the new market transaction does raise many considerations that are best addressed upfront, and particularly for debt sources. So, what are some of these particular considerations? Let's start with the leverage loan, because that's often the more complicated discussion. First is timing. Unlike traditional loans, 100% of the leverage loan is advanced into the structure on the day of closing. This is not as advanced on an as-needed basis like you would see in a traditional loan. Is your lender ready and able to commit to 100% funding on the day of closing? Term. The leverage loan, or the loan that is extended directly to the investment fund, needs to be extended and out there for a term of no less than 7 years to align with the new market tax credit compliance period. This leverage loan extended to the investment fund is also interest only. To the extent your source lender needs some sort of amortization or principal pay down during that 7 years, you would need to structure your transaction to either have a junior leverage lender, again, or more commonly, the affiliate leverage lender who has other sources of incomes available to pay the leverage loan. One of the more complicated topics is forbearance. Forbearance is the concept that if the leverage lender begins to notice either economic or performance defaults on the leverage loan, that leverage lender will be required to forbear or to pause any sort of foreclosure or lien enforcement actions against the investment fund, unless or until a series of very unlikely or unlimited or unlikely scenarios occur. Because this is a foreign concept to many traditional lenders, this drives a lot of early stage conversations. And we are happy to join you in those conversations about why this is unlikely to come into play and or what other kind of tools are out there to give them comfort with this transaction. One of those being the idea of collateral. For the entity that is lending directly to the investment fund, they are limited to what collateral they can take. They cannot simply bypass or go around the structure to take collateral of the QALICB, at the bottom of the chart, as collateral for their loan to the top of the chart. So how to address this? Again, we often come back to the idea of the affiliate leverage lender, which allows the source lender to identify separate assets from the QALICB or other income streams to help give them comfort on what their collateral base would be. Consents. A lender may require that certain actions that occur in the transaction after closing get their consent. And we would work with you and your attorney and the rest of the transaction team to make sure that chain of consents makes sense for this particular transaction. One of the most important pieces about consent is the concept of redeployment. And this is a very rare but serious subject that happens in the unlikely and unfortunate event that a QALICB begins to fail, and that the direct or CDE lenders need to foreclose on that property. And on whatever amounts come back to the CDE lender, they may trigger a need for those CDEs under the New Markets Tax Credit Program to re-advance or re-lend proceeds to a completely different project, potentially in a different area. That source lender likely has an interest in where those proceeds go. And we would need to negotiate with them on how long that source lender, the investor, and the CDE would work together to identify that secondary investment. Disbursement. Now that their funds have been lent into and advanced through the structure, do they have an interest in how those funds are released to complete the ultimate project? And how can they get that when their borrower is technically either an affiliate or the investment fund? And finally, use restrictions. Can your particular source of funding for these leveraged loans be used for this particular transaction? Can you use bond funds? What if there's another state tax credit proceeds? Are there other items that they simply do or do not want to pay for at the bottom of the chart? Your consultant and your attorney can help you work through those early stage conversations to avoid a major point of frustration later on in the transaction. And similarly, your direct funding sources have similar concerns as well. These, however, are handled in a more traditional negotiation between lenders, whether that's the CDE lenders and the direct lenders. But these types of ideas of timing, term, collateral, position, and intercreditor all need to be discussed up front. So with the help of your consultant, you've opened this conversation with your lenders on these topics, and you're ready to kind of advance through the process. And so what else can you do to prepare yourself for the closing process? What else should you do to expect, or what else should you expect to see in that process? And what do you do after you've received the New Markets funds? So now that you've had all these early stage conversations, it's time to reach our formal commitments. You need to have each of the following parties, that is the CDE, the investor, and the non-New Markets lenders, provide formal commitments or term sheets. And so to get those from the CDEs, you need to be aware that they will have early stage requests on diligence on everything they would need to underwrite the deal. Have you worked through the terms of their term sheet? And do you understand their closing timelines? For investors, have you and your consultant talked to a sufficient number of investors to make sure that you're getting the best deal out of this transaction? And for lenders, Does their term sheet reflect the fact that this is going to be part of a new market tax credit transaction? Overall, all these term sheets and all of these commitments need to work well together so that we aren't fighting with each other on who takes what priority or what term later on when we have a lot of attorneys on the call. You've heard me reference attorneys a couple times. Having experienced support and paid professionals on your team is key in a new markets transaction. So have you hired the right attorney and modeling accountant will have a huge impact on how expensive or affordable these transactions are in terms of transaction costs. This is a highly nuanced tax credit program, and using experienced professionals is key. We here at Bekaert like to introduce all of our clients to multiple experienced attorneys and multiple modeling accountants to make sure that we all agree on kind of how this should go forward and that we'll enjoy working together throughout this process. I'd like to pause quickly on the modeling accountants as they produce one of the most critical early stage pieces of diligence for the transaction called the projections. This is a document that takes typically a 1 to 2 page kind of rough sketch outline of the transaction that we here at Bekaert put together and really make them a more robust, generally a 50, 60 plus page document that walks through how money comes into the transaction, how money is expected to be used in the transaction, and then how you as the borrower will repay your obligations over the next 7 years of the compliance period. So now let's assume we've worked through all those early stage items. Once all parties are committed and that initial set of projections have been produced, we typically begin regular deal calls, and these typically occur weekly. We suggest that all parties approach each call with their own agenda of what they want to cover. This can help avoid unnecessarily long or unproductive calls, and this is key when you consider how many attorneys are on these calls billing for each of these parties. And although timelines vary wildly, I've seen them go as quickly as 6 weeks, but as long as over 6 months, 12, even 18 months, this is the primary driver of avoidable costs and the amount of time that you've asked your attorneys to be on these calls to negotiate or work through diligence. So we've had these closing calls. We've been working through this, and we now have, we advance to the next slide here. We now have all of our negotiated documents and all the diligence is collected. We've kind of reached this like very important key moment for the new markets transaction of the movement of funds. But to accomplish that, we need to make sure that we have the right mechanisms in place to accomplish that transaction. So while the whole team has been negotiating deal documents, the sponsor team, and most typically the investor bank, or maybe even a direct lending bank, has been working together to make sure that all the appropriate bank accounts have been opened. And the timing of that is critical because we cannot fund a new markets transaction unless all the accounts are open and ready to go. And also critical to that is, do those bank accounts have the necessary prerequisite funds in them? Say those funds from those source lenders. Those are key. An investor bank cannot move funds forward until they know that that leverage loan is going to be ready and available on the day of closing. But on the day of closing, that investment bank typically runs the process. They will take those funds from their own account, the equity, and they will work to move the leverage loan funds from the source lender into the new market structure and down through it to be available in a disbursement account at the QALICB level. This account, named in your organization's name, will contain the net benefit, which includes an amount equal to the leverage loan plus the gross investor equity, but less the fees, transaction costs, or project payments that were completed on the day of closing, and as Janae covered at the beginning of the call. That said, even though these funds are in your bank account, they are typically restricted and need to follow a process to release. So as we talked about in one of my earlier considerations is, there is a disbursement process. Who is involved? This all comes together in a disbursement agreement. And this is a document that lays out who, being the CDEs, the investors, any direct lenders, or maybe even a source lender, if they're involved in the disbursement project, what items they need to receive, what timelines they have to review, and what timelines they have to approve and release those funds. Understanding these requirements makes the process much simpler. But make no mistake, the CDs and investors want you to be successful in utilizing these funds. However, it can seem more frustrating to those projects that were used to using equity or cash under less formal arrangements. So we've closed on your transaction and we've now moved into fund disbursement. What else could be left? Performance. This is simple. You move forward with your business plans and make your interest payments to the sub-CDEs and whatever is owed to the debt providers. However, as Trevor said, this is a federal program that is designed to deliver impacts, whether that's jobs, services, or assets to low-income communities. So early on in the marketing and negotiation, we've made statements about what you will do for that low-income community. And these all come to become reporting obligations under the loan documents. And you will be required to make regular reports on how you're progressing towards those goals. Generally, the first year or so is the most critical time in this, and it can feel like the most complicated. That said, everything is in the documents and you can engage professionals if you feel overwhelmed by any of those requirements. Finally, you've been progressing past disbursements, you've been in your business plan, and you've been doing this for the 7-year compliance period. After 7 years, the investor has received all the credits they will ever get from this transaction. And at that point, the industry norm is for them to exercise their put option where they get out of the transaction by selling their ownership interest in the investment fund for a nominal price of typically $1,000. A similar assignment of the CDEs interest occurs, and then we have the QALICB in this or their sponsor affiliate owning every part of that deal diagram that we've shown in the earlier slides. When this happens, your sponsor now has the ability to cancel the QALICB debt associated with that original equity investment. This sponsor now has the ability to utilize that converted debt to equity in whichever way best suits their needs. And this is the back-end benefit of the New Markets program that complements that front-end initial cash infusion that you see on the day of closing. And with that, we can move into our final polling question and have time for additional Q&A that may have come in. So the final polling question, would you like to further connect with Cherry Bekaert on one or more of the topics covered today? I'll give you guys a minute. And we've had another question come in, and it was about that redeployment topic. So again, this is a nuanced part of new market tax credit programs where the federal government would like to see 85% of that qualified investment continually invested in low-income communities. So anticipating that some of these projects may not make it, the program set up this kind of 85% sub all of the allocation needs to be in those communities. And so depending on how much money is recovered from a foreclosure, plus whatever is lost to the foreclosure action itself, they may or may not clear that 85%. And to the extent they do clear that 85%, and they have these funds that by the program rules needs to be reinvested, your CDEs and your investor will work with a source lender to find another qualified active low-income community business that is in need of similar financing. This doesn't happen very often, but when it does happen, it needs to be something that people are very intentional and quick to act on. Okay. And so thank you all for coming into today's presentation. And I'll look over to the Q&A to see if there's anything else we can address for today. And while I do that, please take a moment to jot down the contacts here, and Trevor, Janae, and I would be happy to reach out and address or discuss any of your additional concerns. All right, so we have a question here. How can a project get the new market tax credit benefit without needing a leverage loan? Example, the facility is already created, but they need working capital for equipment. What does that structure look like? This is a great question. One of the nice things about a new market tax credit program is that they allow us to do a look back of 24 months. And so to the extent a sponsor has just said, I can't wait for a new markets deal, or they weren't aware, but they want to move forward, the new markets program will allow us to look back for 24 months and capture those costs and essentially refinance those through a new market tax credit program. That can really limit or completely eliminate the amount of cash a sponsor would have to borrow or come up with for that leverage. Again, similar to all things new market, there's a lot of nuance in there, and it's important to walk through those considerations with your consultant, with your attorney, or your accountant well in advance of getting onto one of these large closing calls. Some CDEs like that transaction, or they're kind of, it doesn't bother them. Some CDEs don't enjoy doing that. So it's all about who you're working with, and you want to be there and meet that conversation ahead of time.
Thanks, Joe and Trevor and Janae. You guys did a great job. I don't know if we have any other questions, but I wanted to just go ahead and thank you all for coming. Thank you all as presenters for doing such a great job walking through this presentation. As a reminder, this presentation, if you have any questions or want to hear it again, this presentation will be put up online in a little bit, so you'll be able to find this and watch it over again. Please feel free to reach out to Joe, Trevor, or Janae. We have a team that works on these types of transactions, and Scott Sheffy is also in this group. You're welcome to email me if you know me, or if you want to just check out any questions you may have. As a last housekeeping item, just a reminder again that we have put on a series of 4 of these presentations. The idea being that, some people are involved in new market tax credits, they have some interest in this area, but we wanted to cover all of the waterfront. And the last session we're going to be doing is really talking about people who've heard about new market tax credits, but they really want to build a program. So they want to take the one loan they've made in an area and build a program around that, or they have been involved in new market tax credits and they want to think about becoming a CDFI, or the other way around, a CDFI who has some lending background wants to become eligible to apply for new market tax credit. So we're really going to focus on foundation, assessing your foundation, looking for your strengths and weaknesses, making sure you shore that up before you start building, because if anybody knows anything about construction, if you don't have a foundation that will hold, it doesn't really matter what you put on top of it. So we hope to see you on July 26th for our last session in the series. Really appreciate all of you coming and welcome your feedback. So I believe you'll also be getting a short survey. Please feel free to give us any kudos anything you like, but also tell us what you want to hear more of. If you thought we didn't cover enough detail on a topic, we'd be happy to think about doing another series of these and covering more information in another date. So I think that will be it. Maddie, if I haven't missed anything, I think we have concluded our session, and thanks again to our presenters today.